have a lot of order blocks, usually in a bullish trend, but we have what we refer to as high odds order blocks, also known as, or you can say, no, if I say high odds, it will look like we are betting over here. No, this is not betting. It's not gambling. So let's remove the high odds. Let's make it probability, high probability. When some people hear odds, they think of betting. High probability order blocks. Now, when we say an order block is a high probability order block, what does it mean? We have to know what it means. So when we see them, we know what is likely to happen. When we say an order block is a high odd order block or high probability order block, it means that when the market trades into that order block, it is very, very likely to reverse from there, or it is very, very likely to respect that order block. Let me take it. A high probability order block is an order block that price is very, very likely to respect. When I say price is likely to respect, it means that, let's assume that this is the order block, okay, somewhere here, and the market is coming from this side. It's bullish, coming from this side like this. It's headed towards the order block, okay? Then it trades into the order block like this. Now, what it means is that when the market trades into the order block, or maybe not into the order block, but just below it, touching the below of it, or touching the bottom part of it, or even trading into it, what a high probability order block means is that price is very, very likely, about 70 to 80% likely to respect that order block. Now, when we say price has respected an order block, what does it mean? It means that price was not able to trade above the order block like this. Or should I say it wasn't able to trade beyond the order block like this, but it's rather got rejected either within the order block or at the bottom of the order block, and then it started to move down. This is a bearish order block, okay? So there are a lot of order blocks, but not all order blocks are high probability order blocks. So you want to train your eyes in such a way that you can identify these high probability order blocks, because once the market goes towards that order block, that trade is likely to play out, very, very likely to play out. So you must take note of that. Now, these high probability order blocks have certain characteristics. Now, as you already know, we have bullish order blocks and bearish order blocks. So let's look at the characteristics of a high probability bullish order block. Let's start with a bearish order block first. I'll do an illustration and then I'll explain. Now, but before I even do the illustration, let me mention one of the ways by which we can, or the major way by which we can identify a high probability bearish order block is that there are usually stops just under the bearish order block. Stops. And I believe you know what stops are. When I say stops, I'm referring to equal highs, double tops. That's what I mean by stops. Or old highs, equal highs, double tops. That is what I'm referring to as stops. Okay? So how does it usually look like? Let me do an illustration. Then we'll go to the main chart to look for example. Let's say this is price doing S10, like this. Then the market comes down and decides to go back up. Now, it's going back up. Observe something. Initially, the market was bullish here. This was a bullish run. Okay, that was a bullish run. A bullish run, a move upwards like this. We can see an impulse swing to the upside. Then there was a reversal here. We saw the market begin to reverse somewhere here, and then it started coming down. Okay, now this was a point of reversal. Now we have realized that the market is trading back upwards towards where it previously reversed from. That is this zone. But then right above, so this is a double top formation. And I've told you severally that double tops are not places where you should be taking trades. You should not be selling at double tops, because the institutions know that many retail traders are selling at these double tops. And if retail traders are selling at these double tops, they have their stop losses just above those double tops. And for most traders, the range is 10 to 70 pips. Just few traders can hold trades over 100 pips and loss. Most traders can't. So most traders have a stop loss of about 10 to 70 pips maximum. And they know that range. Okay. So This, according to the knowledge out there, is a good sell setup, the double top formation, and it's true. It is supposed to sell from there, but because they know that a lot of people are selling there and have their stop losses above, they usually run the market above those highs to clear everybody that was selling there and set their stop loss above, to clear them before they drop down. Now, once you see a double top formation like this and you see the market trading upwards towards that direction, then you look above that double top, this one, and then you see a bearish order block there. Let's say this is the bearish order block. This rectangle is the bearish order block. Okay, that is the bearish order block. Let us extend it to the right. So the market is what? Moving up towards that bearish order block. Now, when it gets here, where this horizontal line is, don't sell it. Those are double tops. It's a trap. If you are selling from here, anybody that is selling here has their stop loss somewhere here, this zone. So they have to go up to clear those stop losses before they come down. Okay, so if you look above those tops and then you see a bearish order block there, that bearish order block is a high probability order block. There's a very great chance that once they clear the people over here, they are moving up and trading into that bearish order block before they start to drop nicely. So while the less informed trader is selling at these double tops, you should be selling at the bearish order block just above those tops. That's why I'm saying for a high probability order bearish order block, we have stops just under the bearish order block. Now these are the stops. These double tops, they are stops. When we say stops, we are referring to double tops and highs, equal highs, or double bottoms and equal lows. So you have the bearish order block that is just above these stops. So what you have to do is to wait for the market to trade above those stops and then clear the liquidity there, then trade into that bearish order block. So as the less informed trader is selling from here, you are rather targeting to sell from the bearish order block. So that is how a high probability bearish order block looks like. Now I want to be sure that you understood my illustration. Okay, I'm getting positive feedback. So what we do right now is we are going to go to the live chat and look for examples. We'll come back and look at this example when we are talking of high probability bullish order blocks, because this is a perfect example. This is a trade I actually missed, and up to now I am biting my teeth because it's a very, very nice setup. I should have placed a pending order. I forgot to do so. And from where I wanted to buy it, it's been going up for 146 pips. Very nice setup. So let's look for what I was talking about. Then we continue. They are quite common. I'll do my best to identify a lot of them. Is this one? Yes, I think so. Now look at something. This is a bearish order block. I like to see these things on the bigger time frames. When I see them on the bigger time frames, I'm happy because it means that it's a big money move. But this is not a perfect example. Let me look for a perfect example so I can show you. Because it's the first time I am introducing it to you, I have to look for a perfect example for you guys. Is this one? The market trade back to this level? No, it didn't. Let me scale it to the daily time frame. Yes, this is a perfect example. Now look at something. Let me zoom in so all of you can see. I may have to take off these drawings for now. Now, obviously, this is a bearish order block. The last bearish candle before this move, before this, the last bullish candle before this sell, or this swing, what you impulse swing to the downside. That's a bearish order block. Now, look at something. These are stops. This is an old high. When we say stops, they are double tops, double bottoms, equal highs, equal lows, or old highs. This is an old high. Okay. It's an old high. So you can see that the market traded above it. Let's place a horizontal line and extend it. You can see that the market traded above it. Okay, and just above it, we have a bearish order block. The market didn't exactly touch the bearish order block, and that is because we have a gap here, which we'll be looking at on Friday, how to identify these gaps. So after filling the gap, they just decided to go down. They didn't trade into the bearish order block. But this is an example. I'm looking for an example where there were double tops or equal highs, and yet they traded above and into the order block. I think we will see some very soon here. Someone is saying, what is an old high? An old high, a high that is old. As simple as that. This is a high and it's an old high. I think there's a nice example. Look at this. Look at this bearish order block. This one. Let's extend it to the right. So let's assume that you saw from here that the market was going up from this point. Okay, it was going up, and so you're looking for sell opportunities. These are equal highs, relative equal highs, because they are not exactly on the same level. I'm referring to this high and this high. They are relative equal highs. The difference is marginal. So you extend it. Okay. Can you see how they traded above those highs? This is what I'm talking about. I'm talking about these relative equal highs. See how they traded above it, traded right into the bearish order block before they started to sell. So if you sold from here because you thought this was an equal high, that looks like, if we go to the smaller time frames, it will appear as a double top, and you decided to enter the trade from there, you would have had a drawdown of 143 pips. I don't think you hold your losing trade for that long. 150, it's even 152 pips. You would have waited for them to clear those highs before. Now they cleared those highs and they traded into the other block before they started to drop. Now somebody asked me a question the other time that after they have taken out those highs and they've traded into the other block, should you start selling? Because he realized that sometimes when you sell, the price continues to go up and then trades a bit high. So if you sold from here, you will be in a big drawdown. Now, to solve that problem, after they have cleared the highs and then they start to trade into the other block, if you are seeing this on a big time frame, like the daily time frame, switch your chart to 1 hour, 30 minutes, or 15 minutes. Observe those 3 time frames and look for a break in market structure in the form of an M pattern like this. Now, once they trade into that bearish order block, and then you see an M structure like this in 1 hour, 15 minutes, or 30 minutes, okay, and they trade back to the midsection of the M, that is when you should sell. The break in market structure will appear on a smaller time frame. If you want to avoid a big drawdown, scale down to the smaller time frames, 1 hour, 30 minutes, or 15 minutes, and look for this structure. Once you see this structure form, and then they trade back to the midsection of the M here, like this, you should sell it. That way, you will not get a huge drawdown. Yes.